Alright, this is the strategy introduction video. Good day, friends. If you want to have more of this, you can go to my website, synergysquad.com. There are many content in the website, but as to this particular trading, you can go to synergysquad.com/trading. That's Synergy Squad Limited website. You can also visit our Facebook page, Synergy Squad Limited, as well as our Telegram channel. So, in the course of this video, I'm going to begin with the basics of supply and demand in a simplified way. It is one of the most powerful trading strategies that is built from economics, and the idea is with a law of supply and demand. So, as to this particular strategy, it is a Ham methodology. So, this law regulates the behavior of buyers and sellers, not just in the financial market, but in all markets you can imagine. And that is why every trader should learn how supply and demand works when applied to price action and technical analysis by using recent past to predict future price movement. Remember, this is for educational purposes only. So while it can be profitable, you are using this strategy at your own risk. Yes, these are the video contents. First of all, we are going to know how the law of supply and demand works, followed by how it controls all markets, how, why, and when prices rise or fall, what happens to supply and demand when price reverses direction, how to use supply and demand in technical analysis. So, in this, you have to note two things. And what are they? Know the economic idea of supply and demand and how it works, and then compare this when making your technical analysis and price reading. For this trading strategy to work, this supply and demand Ham methodology, these two above must be true. And that's the only way you can trade supply and demand alongside understanding equilibrium profitably. There is no doubt about this strategy because that is how economics analyze the economy. That is how each and every market works, whether you are a trader, a financial trader, or not. So, this is how it works. When we talk about demand, we are talking about buyers in the market. And buyers are those who demand or seek for products or services. So the law of demand says the higher the price of something, the less buyers will buy it because they want to spend less. And that's why expensive items are sold in lower quality. How about supply? When we talk about supply, we are talking about sellers. So, sellers are those who provide products, services, or financial assets. And the law of supply says the higher the price of something, the more sellers will be willing to sell it. And so, the supply increases because they will make more money by selling it. While price rises, sellers are willing to sell to make more money, while buyers are willing to buy less because they want to save more money or spend less. So, but when price is lower, buyers are willing to buy more, whereby sellers are willing to sell less. So, we'll continue by going to the next one, and that is the curve, the supply and demand curve. On this, we want to have this as the y-axis, that is the price, whereby the x-axis is the quantity demanded. So, according to the law of demand and supply, it says the higher the price of the product, the lesser the quantity demanded, and that is why we have a slope downwards. And that also applies to supply, the y-axis and the x-axis. The higher the price of an item, the higher the quantity supplied because sellers want to sell more in order to make more. So Let's now treat supply, demand, and market equilibrium same time. So according to the law of supply and demand, price will always seek the market equilibrium. When we talk about market equilibrium, we are talking about equal buyers and equal sellers at the same time, which is the point where the supply and demand curves cross each other. So when the supply and demand curves move, the point of equilibrium will change naturally. This is the y-axis of the price, and then this is the quantity. We want to bring all these now together. The higher the price, the lesser the quantity demanded, and that is the demand curve. And the higher the price, the higher the quantity supplied. That is the law of supply. Now, at this point, as we said earlier, where there are equal buyers and sellers in the market, is the point of equilibrium, the point of satisfaction, where the buyers are willing to buy, the sellers are willing to equal in the market. So this leads to what Adam Smith says about the invisible hand. He says that there is a self-correcting mechanism that automatically adjusts price based on the free will and self-interest of buyers and sellers. And that is the true reflection of human nature. So if market will always correct itself, what causes price to change? That brings us to another, which is supply and demand shift. Yes, the number of persons who are buying or selling in the market are always changing, which are a reflection of buyers and sellers changing the perception or their perception based on speculation about the value of a market. At some points, they may tend to feel this is high, and so they buy less, or this is low, and then they buy more, or this is high, and they sell more, and this is low, and they sell less. So that brings us to another, which is price and value. Talking about buyers and sellers, supply and demand. Price is a number on the screen that represents the current market equilibrium, whereby value is how buyers and sellers perceive price. Do they perceive it to be high or low? The perception of value changes first. That is when something is overrated or costly or undervalued or cheap. Then the supply and demand curves shift, making buyers and sellers reach a new equilibrium, which will reflect in a new price. So this is a graphical representation of supply and demand shift. At this very point of equilibrium, based on the perception of the value of a price, there will happen to be either a shift downwards or upwards. When there is a shift upwards, market seeks a new equilibrium. This is a demand shift. Now, the same thing also is applicable to that of supply. When there is a new value or perception of price, then it makes a new equilibrium. And that is what we have here, from point 1 of satisfaction to a point 2 of satisfaction. So this demand curve or shift can either be high or low, as well as that of supply. It can either be low or high when it comes to the shift. So it shows what motivates buyers and sellers to produce movements in the market. How about the use in technical analysis and price action? We can use the recent past of price to understand the near future of price, because the market has memory and reacts to past events in a predictable way. Even though this is true, it is not true all the time. It is only true when there are no other stronger forces acting on price, like major news or macroeconomic forces, which tends to make it unreliable. That's why you will do everything right sometimes and still fail. because those forces make markets to change direction. If we can identify supply and demand changes, it might help us in the future. The market has some historical memory in the sense that whenever there is a change in the market and market comes back to that level, it reacts to same change. Well, we are going to see by the use of a graph or bar to represent what we mean by this. First of all, you have to know these three things: that the move should be higher or lower than the initial to be valid. Then the second is we can extend the zone horizontally to project the next possible significant move from the recent past historical price history. Then the third is draw the zone from the absolute high or low to the candle's close. Yes, on this, we will have to bear in mind that a low formed between two highs is a demand zone. And so you can see a high is formed, then a low, and then another high. So from what we said earlier, the move should be higher or lower than the initial to be valid. And we said that the low between two highs is a demand. And this second high is higher than the previous high. So this now becomes the demand zone. The second says we can extend the zone horizontally to project the next possible significant move. And that is it, forming the base. So that in the future, those who made price rise, the market players that made price rise higher than the previous high, when bracket comes back to that level, they will do it again. And so when market arrives at the base, it makes another high, predicting the next possible significant move. And the third, we said that we will draw the zone from the absolute high or low to the candle's close. But to this now, we are drawing the zone from the absolute low to the candle's close for a demand zone. Now, let's get to supply. A high formed between two lows is a supply zone. Now, this is a low, this is a high, and then another low, lower than the previous low. Just like the first, the move should be lower, in this case, than the initial to be valid. Next is, we can extend the zone horizontally to project the next possible significant move. And that is, with this rectangle, we draw the base into the future, projecting the next possible significant move. And then the third, draw the zone from the absolute, this time, high to the candle's close for a supply. So that the market players that made price drop the previous time, when market arrives at that level, they will do it again. And so that is how the supply and demand market moves. Supply and demand zones with risk management. Based on this strategy, it allows us a good risk management because we know what we'll be risking in every trade, and it gives us a logical stops or logical stop loss where we'll place our stops so that when market violates them, we know we did not suffer much. We did not suffer much loss. But what we set to lose is only what we will lose. It will not be damaging. But if we should be on profit, it gives us enough profit so that when we lose, most of the time, we'll still break even. This is the trade earlier. When it gets to the zone, it makes the move, giving us profit. For the supply, the same thing with a logical stop loss. Now, using supply and demand zone provides a naturally small and logical stop that allows you to use 1 or 3 and 1 to 4 risk to reward in your trades to survive trading for a long time. How do we mean on this? As when we discuss about risk management. Yes, when we talk about risk management, at least 1 to 3 risk reward should be your goal, because it will take 3 bad trades to wipe away 1 good trade, and you can lose 3 times and still break even. That is 75% error. or 75% error. Then, if it is 1 to 4 risk reward, you'll see that it takes 4 bad trades to wipe away 1 good trade. So you can lose 4 times and still break even. That is 80% error. So trading doesn't mean perfectly winning all the time, but having enough room to make mistakes and still make money. Let's take some examples. These are some of the trades taken. You can see, we said when there is a low and then a high and another low, we draw from the absolute high to the candle's close. These refinements that we're going to discuss in subsequent lessons, but it's supposed to be to the candle's close. Although this is a good trade, even by the refinement, it's also a good trade. So that when market comes back to that level, those who made markets drop, the market makers, the market players, they will do it again. And then, if you check here, there is also another drop, making 2 highs. And so, extending to the future, when it got to that level, it dropped again. There is also another example, although this is like a reversal pattern that will also be discussed in other lessons that follows. You can see a sell area as low as 7 pips. When market drops, getting back to that level, it dropped, providing another opportunity to the candle's close. But by refinement, it's also okay. I missed by a few pips. This is what happens when you refine more. But it's also nice. What we want to know there is that we know what the market is about doing and we follow it. So it provides many opportunities as to these trading techniques. And market dropped and drops and drops. And so these are fine examples. There are also major advantages of supply and demand. The major trait is principle. The second is risk to reward, and then market memory. When we talk about principle, we know that supply and demand has a solid principle which is derived from economics, and this law regulates the behavior of buyers and sellers, not just in the financial market, but in all markets you can imagine in the world. Then, as to risk to reward, using supply and demand zones provide a naturally small and logical stop that allows you to use 1 or 3 and 1 or 4 risk to reward in your trades to survive trading for a long time. Then, as to market memory, you can use the recent past of price to understand the near future of price, because the market has a historical memory and reacts to past events in a predictable way. Yes, this is just an introduction, and there is more contained in other lessons. There are sessions, there are videos, there are guides. What everybody knows is not worth knowing. But I hope you learned something useful today. Well, you can enroll for these strategy guide sessions and videos. And you can also visit the site www.synergysquad.com/trading. If you should go to this on the screen, you see other services. But trading is one of the major /trading. And also get us in our Telegram channel or our Facebook page, Synergy FS Squad.